With all of the attention, focus that the Iranian war has legitimately generated in this period of sort of ceasefire, the question keeps arising, bubbling up, if a resurgence in the Iranian war would be a serious impediment to the ongoing bull market on a global basis. And the answer is, well, is it this or is it that? If you say a resurgence is the US and maybe Israel and maybe a couple of other Western allied Gulf countries increasingly engaging in conflict, whether with boots on the ground or not, with Iran and Iran solely, then the answer is almost surely not. The possibility of that has been long contemplated and therefore would not be a shock to markets. Secondarily, there is this very, very long history of regional wars never causing bear markets. You get a world war, that's a different thing. We don't get a lot of those, fortunately. If we get other major antagonists together, if, for example, it started to involve armament on support of Iran from, and you can make up names, China's the one that most people would fear the most legitimately, but Pakistan perhaps, otherwise perhaps some other Arab countries that are not allied with the West, perhaps the Russians, who are pretty well pegged down with what they're doing in Ukraine now. That'd be a hard stretch to imagine. But the fact is, if it turned into more than a regional conflict, yeah, that could do it. If it remains a regional conflict with slightly different players, we have a very long history of that. And these do not create bear markets. There is no history of that, despite many of them in history. And therefore, I would say, do you know it will not? I've written a fair amount about this war. I've ongoing views about details about it. Most of them are not unique. Mostly they all fall within the subset of regional wars that have been energy-centric regional wars. Some shorter ones, some longer ones. But this one does fit into that scope. And I would say that the bull market can persist quite abundantly. And the biggest reason for that, let me just take a few more moments, is that if you think about what I've described before as the methodical three steps of an energy-centric war, the first one is before the fighting begins, tensions build, and with those building tensions, the price of oil goes up in a form of saber rattling. And then you get to the fighting itself, which explodes the fear, and markets begin to immediately and very quickly, on top of immediately, pre-price all worst case outcomes. And then, a little bit later, but not very long, starts pre-pricing more likely outcomes until you get to where it prices the fact that this is temporary, goes away, doesn't have long-term economic damage. That's often hard for people to figure out as it's going on. Now, if you think of this one, the big bugaboo has been that after the initial burst of activity, you have this continued issue of the Strait of Hormuz being blocked off, and therefore oil not going in or out, product not going in or out, and therefore this notion that, but boy, oh boy, if this goes on forever, isn't that going to be an insurmountable burden? The answer is, it's a burden, but it's not an insurmountable burden, and for two principal reasons. If you think of the primary non-Iranian Gulf producers, the bigger ones, Iran's not that big a producer, 1.7 billion barrels a day pre-conflict. Not very efficient producer either. If you think of the big ones, the Kingdom and the Emirates, and then secondarily Iraq, particularly with the kingdom, which before the war was shipping about 800 barrels a day through its east-west pipeline into the Red Sea, and then that going either south out past the Houthi barriers, but more commonly north now through the Suez Canal. That's doing 5 million barrels a day now. The UAE is upping its output that does not go through Hormuz. And then outside of this entire region, oil producers are increasing their output because of the higher prices that exist. And that will continue as long as the higher prices exist, which then in a normal demand and supply modality will bring down prices over time. This that Iran does is temporarily working and can for the intermediate term, but that does not make global GDP go down. Global GDP numbers have been okay. It does not create a bear market. We've been hitting all-time highs in most major currencies in the all-world indexes. And therefore, this is not something that creates the problem that people most fear. The workarounds will continue. More will be done to make the Gulf countries, ex-Iran, less dependent on the Strait of Hormuz, even though the Strait of Hormuz is the optimal way to move product in and out of that region. The region will become, if you will, more diversified within 12 months, and prices pre-price that. Thank you for listening to me. I hope you found this educational, perhaps useful, and I always enjoy it, and I hope you do too. Hi, this is Ken Fisher. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.